your IRA invests in raw land. Well, what are you going to do with that, right? How's that an investment? What's that? It's just sitting there. But like I went to Iowa last summer and I'm looking at all this raw land, I'm like, look what people could do with raw land. They could grow corn. Like I'm going to lease your raw land from your IRA and I'm going to plant corn on it and I'm going to have a crop and I'm going to do that. I'm just leasing the land from you so that I can grow this corn. Or maybe I've got cattle. I'm going to feed my cattle on your raw land. Or maybe I have a windmill. Can I put my windmill on your raw land and lease it from you? Like things you may not have even thought of, right?
Wow. What is up, everyone? Welcome to another episode of The Remote Investor. I'm Michael Album, and today I'm joined by a very special guest, Kaaren Hall. She is the founder and CEO of UDirect Self-Directed IRA Services. We are going to be getting into all things self-directed today. It is a super fun conversation, and I highly recommend listening to the whole thing. I'm slightly biased, but there is a lot of good nuggets in there. So let's get into it. Kaaren Hall, welcome to the show. Thank you so much for being here. I'm really excited to have you.
Oh, thank you, Michael. Appreciate it.
No. It is so my pleasure. And so you and I were chatting just before we hit record. I know a little bit about your background, but for everybody listening who might not be familiar with you, can you give us the quick and dirty who you are, where you come from, and what is it you're doing in real estate today?
Yeah, I come from a background of real estate largely. Starting in my 20s as a realtor, and property management. And then as the years went by, loan servicing, loan origination, and got into the self-directed space in 2007. And in 2009, broke away and opened UDirect IRA Services. And so we've been going strong. We have over $1 billion under management, and we're helping thousands and thousands of Americans, self-direct and, build their retirement.
Amazing. 2007 seemed like a great time to be in the financial space, right? Tell us about that.
That was a crash. That was when it was all going down, and so opening this company in 2009 was really the bottom, I have to say. But it was a great time for the self-directed space because people buying houses then, or buying properties to invest in, could only get 6 loans. Normally it's 10, right? You can get loans on 10 rental properties, but then it was only 6, and people are asking themselves, where do I find capital? And investors began to realize, hey, I can find capital in self-directed IRAs. And right now it's like a pool of like $40 trillion that you could tap into for your deal. So it's huge. And that really hit the investor mind. So many people have old 401ks or retirement money stockpiled. And they're like, well, I'll take that and I'll deploy it. This is a great situation. I'll buy these. Remember, you could buy properties on tape. Remember that?
Yeah, totally.
Yeah. And people were doing that in their IRA. So it was a super great time to start this. And that's really, I think, when the investor world really clued into the self-directed IRA.
Interesting. Okay. And so you were telling me too, before we hit record, that you are also an investor. So you're not just talking the talk, but you're also walking the walk.
Yeah. I have some single family homes in the Midwest that are great. They're just so great. It's fun as heck to flip them and to rehab them. I really enjoy that part. And I've had good tenants. So far, so good,
Amazing. Well, I'm so glad you mentioned the fact that they were in the Midwest, because as we all know, this is the remote investor. I would have been really bummed if you said, oh yeah, they're next down the block for me. So good answer. So there is so much, I think, misinformation or a lack of transparency, or just frankly, not enough information about the self-directed space. So if you can give us the 10,000 foot high level of how can people access funds in a retirement account to use for real estate investing?
Yeah, 2 ways. One, if it's your retirement money, you can transfer an IRA, you can roll over a previous employer plan, or you could contribute. You have these contribution limits, and so every year you can put so much into the account. So 3 ways to get the money in. But if you're the investor looking for capital, then ask people, hey, do you have an IRA? Do you have a 401k with an old employer? Because if they do, they can move that money into a self-directed IRA and invest with you. So maybe you don't need enough for the whole property. Maybe you've got a property you're working on and you're rehabbing, and you're a little short for the kitchen. You need another like 20, 30 grand to finish the kitchen. Someone's self-directed IRA could invest in your deal, secured or unsecured, and then say you sell that property and they get paid back at a closing, for example.
Holy smokes. I've done this, and I just had this aha light bulb moment. So, okay, let's back up for a minute here. You said if it's your money. And so I work a W-2 employee. I have an employer. They have a 401k plan. So in this instance, is that money not my money, like you're referring to?
Yeah, it is your money, but It is your money for later. It's tax protected money for later. It's a retirement account. You get these special tax benefits, and the reason you get the benefits is because you agree to save the money for later. You can always take it out, but if you do it early, you get taxed. You get maybe like a penalty, and so that's what happens. You can always take it, but not all of it. Typically.
Okay, got it. And
Yeah.
who can have a self-directed IRA?
Literally anybody. The barrier to entry to have an IRA is like self-directed IRA or typical IRA, same thing. It's just the asset class is different. So the only qualification to contribute to an IRA is to have earned income from a job. So you have to have a social security number, you have to be an American, and you have to have earned income from a job. And that's a pretty easy test to pass. And that's what it takes. But if you're going to self-direct, usually you have a little more. Usually the self-directed investor is somebody who's maybe worked a couple of jobs and built this kind of nest egg so that there's enough to actually take down a larger asset, maybe like a syndication or maybe lend money as a note. But you can also start off with micro deals. So there's really no barrier to entry except, earned income.
Okay, so I'm a W-2 employee. I have a 401k company-sponsored 401k plan. I could go out and open up a self-directed IRA, and I could simply put money, after-tax money that's part of my paycheck, into this IRA on my own accord.
You could. In fact, so talk to your tax person too. Always, whenever you're investing, especially with IRAs, you want to have a good tax person you can chat with because they're going to make sure you get the credit, for doing this. So, so you can have an IRA. It could be after-tax money, or it could be pre-tax money. So pre-tax money is a typical, like a traditional IRA. After-tax money is a Roth. So you can have this 401k over here with your business and this IRA over here. You can do both, like traditional or Roth.
Yep. Okay. And I've seen online, and it's been an ongoing debate, I think, since the Roth was created, I think in the 90s, but Roth or pre-tax money, which do you like better for investing in real estate?
Well, Roth money, who doesn't like tax-free dollars, And that really is the brass ring. Everybody wants Roth. And by the way, here's a little side note about the Roth, and that is that when the Secure Act 2.0 passed, I'll just try not to go in the weeds here. But when the Secure Act 2.0 passed, now if you have a SEP IRA, that's if you're self-employed, it's a simplified employee pension, it's an IRA, you can contribute Roth dollars to that plan. And it can be as much as the cap is $70,000 for 2025. So if you're self-employed, you make a certain amount of money, you could contribute possibly up to a potential $70K a year of Roth dollars into a SEP IRA.
Is it the normal contribution limit like $6,500 for a Roth IRA?
No. Oh, well, I see. It's 8,000 now today in 2025. Yeah, no, it goes up every year. So it was once, but now it's $8,000. And but for a SEP, it could be as much as 70,000.
Holy smokes!
Yeah.
Okay.
Nobody knows that. Nobody's doing that. It's crazy.
Yeah, this is amazing stuff.
Yeah.
Okay, so for the self-employed folks, we've got the SEP. For the employed folks, we've got the traditional IRA. Can I move money from my employee-sponsored 401k into a self-directed IRA?
Well, sometimes is the answer. I mean, if you leave
I love
service,
it.
if you quit, you can move it over, no problem. And that's no problem. It's called a rollover. But if you're still working there, you can ask the plan administrator. Can I have an in-service transfer? I'm working there, I'm in service. Can I transfer the money while I'm still working there? And they might say yes. You're obviously not 59 and a half, but sometimes that's one of the barriers. If you're 59 and a half, then a lot of times they'll let you do that. Or if you worked at like company A and it was bought by company B, the money from company A that you brought over, you might be able to roll that over into a self-directed IRA while you're still in service at the company. You just have to ask the company plan administrator because it's in this contract that the employer signs.
Got it. Okay. Well, that's a great question to go ask because as so many of us, especially our listeners know, if they have an employee sponsored plan, there's a choice of menu items of assets you can invest in. Real estate isn't one of them. And so that's the beauty of getting into the self-directed space is you really get to dictate what your money does.
That's true. And so I should kind of blow your mind right now and tell you that with the Big Beautiful Act, you're going to be able to invest in real estate with your 401k.
What?
Yeah, no joke.
Okay. Tell us more. I'm
Yeah,
super
well, I mean,
excited.
it's new, watch this space for further news, but it's
Yeah.
coming out. It's going to be unveiled. A lot of things that are enacted as law, we don't get guidance on them for, straight away. It'll take a minute. But yeah, they want to allow people with employer plans to be able to invest in things like private equity and real estate. And the big beautiful
Wow.
bill is going to allow that. And so then when you leave the employer, then you're going to want to move that money into a self-directed plan that can hold those assets.
Interesting. Okay. This is great to know. Man, well, I have so many questions. That's why the reason you're here. This is awesome. So, what are some things that people need to be aware of? They're hearing this episode, they're getting super excited. They maybe have, let's say, a self-directed left over from when they left the job previously, and now they're like me and have a 401k with an employee-sponsored plan. What do people need to be aware of if they want to invest in real estate?
Well, the number one thing is to just wait, not just jump into a deal, but really do your homework. It's so easy to get enthusiastic about a deal. When you see something, oh, I really want to do that. And we all want to move forward and take action and action-oriented people. But the best thing to do is stop and really evaluate the situation, because you're putting these hard-earned dollars into this deal. If the deal goes south, you don't get to write off those losses, right? You just lose money.
Mm,
So it is very, very important dollars that are supposed to be for later. So you want to do your homework. So if it's real estate, so we're talking about single family homes here. So what do you do for due diligence? You check, you get a preliminary title report, make sure the seller actually owns the house. Let's start at the basics,
yeah, yeah.
because I think people can be trusting and not even realize that they bought a house from somebody who didn't own it. Happens. I would start there. And then also take a look at the neighborhood and, do the normal due diligence things. What's the value? How does it compare to the value of the other properties in the neighborhood? What's the local business around there? What's the likelihood of getting rental income? Because self-directed IRAs are just for investment purposes only. You're not going to move into the house, that your self-directed IRA owns. It's going to be an investment property. It's going to be a rental. So what's the rental market like? So do a rental survey. What's a normal rent for that neighborhood, and how is that going to compare to your expenses? So you want to do that kind of list of items and pros and cons about the deal before you jump in, and then invest, and then you'll have a plan and you'll know how to execute it. So that's the number one thing, is the due diligence.
That's great. And can I invest in any kind of deal? Can I invest in obviously it can't be a single primary residence for me, but I can invest in single family, multifamily, syndication, fix and flip, anything.
Self-storage, mobile home park. Yeah, absolutely. Strip mall, which is normally done through a syndication. When you're investing in a commercial property, usually you do that using a syndication, to get a part of a chunk of a really big deal. But yeah, every kind of real estate. Raw land, for example, is something people don't think about. Like, your IRA invests in raw land. Well, what are you going to do with that, right? How's that an investment? What's that? It's just sitting there. But no, you could, I went to Iowa last summer and I'm looking at all this raw land, I'm like, look what people could do with raw land. They could grow corn. Like, I'm going to lease your raw land from your IRA, and I'm going to plant corn on it, and I'm going to have a crop, and I'm going to do that. I'm just leasing the land from you so that I can grow this corn. Or maybe I've got cattle. I'm going to feed my cattle on your raw land. Or maybe I have a windmill. Can I put my windmill on your raw land and lease it from you? Like, things you may not have even thought of, right? So,
Wow.
yeah.
This is amazing. For anyone watching, I've just got this ear to ear grin on, because just like the wheels are turning there. This is so not taught and not talked about. So I love the fact that we're having this conversation, Kaaren. Um, Fix and flip. If I want to go do the work myself, I've heard there's some kind of gotchas to be aware of.
For sure. And those gotchas are called prohibited transactions. So yeah, you're right. You can't offer services to the plan, and you can't have personal benefit to the plan. So that's how it's written in the Internal Revenue Code. So what that means is you don't swing the hammers, you don't do the physical labor. You can hire third parties to do the labor, but you don't do it. And you just keep arm's length from that property. You don't live there. You don't physically do the work.
Could I be the realtor that sells it?
No, because then if you got a commission, that would be called personal benefit. So you can't personally benefit today. That IRA is all about later. And it's not about benefiting today. Yeah.
Okay. So if all of the profits or all of the income have to go back into the IRA, and
Yeah.
that's where they live. Nobody outside the IRA can't get a benefit from this deal. Is that what you're saying?
That's right. That's right. So you personally don't benefit. For example, you don't use the money from your IRA deals to pay your mortgage. That kind of benefit. It's not your personal cash. It's your retirement cash that you're getting a tax benefit on to save for later.
Okay. Okay. That makes sense. I've heard the argument made that, well, you don't get depreciation benefits inside of a retirement account. So it's kind of a waste to invest in real estate
Well, you
because that's such
might.
a big benefit.
Yeah,
I
you
might.
might. Yeah.
Tell
Yeah.
me
There are
more.
two ways you could use depreciation with a self-directed IRA. Okay. And one way is, say your IRA is going to buy a single family home
Okay.
and you don't have enough money in the IRA to buy it entirely. So
Okay.
what you do is you go out and get what's called a non-recourse loan, which means it's not conventional conforming Fannie Freddie or anything like that. It's like a portfolio loan. And we have a list, by the way, that we'll provide to your listeners. If they want to hit me up at info@udirectira.com, I'll send them that list of non-recourse lenders. So you've got some money in the IRA, you've got a loan, and you put this deal together. You want to have extra money, by the way, some extra liquidity in the IRA after the deal to pay for expenses. But say it's like $100,000 property, just for math, and your IRA has $70K and you borrow $30K. Your IRA borrows $30K. So now you've got this property. Now here comes $1,000 rent check. Well, $700 of that was earned because of leverage, right? And $300 was earned. I'm sorry, $700 was earned because you saved. That's what I mean to say.
Right.
$300 was earned because of leverage. So that $300 is subject to a tax. Like, I thought these were tax-free, tax-deferred, but there's a special tax called UDFI, Unrelated Debt Financed Income Tax. All right, special tax. Your IRA files a 990T. Okay, so we're back to the depreciation question. So when your IRA has to file a 990T, can you take depreciation or write-offs? And the answer is talk to your tax person, and yes, you can. So your IRA can do this. You can use the depreciation to reduce the UDFI tax. Always work with a competent tax professional. I'm not a tax professional. I just kind of play one on TV here.
You play one on TV? Yeah. You could have fooled me.
Yeah. But that's one for the depreciation. Yeah.
That's incredible. Okay. So, and obviously understanding you're not a tax professional, we're two friends speaking about this. The depreciation, is it just like if the property was outside an IRA and the depreciation is based on the purchase price, the building, obviously we can't depreciate land, but it's based on the purchase price? Or is it different now because it's inside of an IRA and we happen to use 30 grand of leverage?
Yeah. Ask your tax professional.
Okay.
We'll leave it there. Yeah.
I
don't want to go in the weeds on that.
Perfect. Okay. Well, this is so great to know.
Well, but there's another way, there's a second way.
Tell me.
But wait, there's more.
I love this.
Okay. So the other thing is, like, people invest in syndications, right?
Sure.
And what bites them in the shorts is that they don't know they might have to pay this UDFI tax. Why? It's because if their IRA has an equity interest in a syndication and that GP, that asset sponsor, as part of their capital stack has leverage, it's going to throw off this UDFI tax to your IRA. And you may or may not know that. And we've had people call and say, hey, Kaaren, I got this letter from the IRS. They want to know why I haven't filed a 990T in 3 years. What is this? What is this? It's because they invested in a syndication and they received proceeds, and part of those proceeds were earned due to leverage, but they didn't know that meant that they had to file a 990T.
Oh my gosh.
Yeah.
So in those instances, were the LPs, limited partners, the people that actually invested in the syndication, not getting a depreciation benefit?
Well, they could get a depreciation benefit, but only if they file the only if they know that they need to file the 990T,
I see.
Yeah.
I see. So, okay. So on their K1 that they're getting from the GP, it says, hey, you earned $10,000. They have to then go file this 990T to say, yep, I earned 10 grand. But, oh, by the way, 7,500 of it is depreciation covering.
Yeah, exactly. And your tax person get a good tax person. If when we're investing, we have to have kind of like a like a stable of really good advisors, a good lawyer for your contracts, a great tax advisor to handle questions like this, a good insurance agent, a good realtor. You want to have that realtor that's super investor friendly and
Mm-hmm.
somebody who knows all the subcontractors in the neighborhood. So you can call them and like, oh my gosh, I need a plumber at 3 a.m., right? So you need all
Yes.
these things, whether you invest with an IRA or not. But yes, you can take depreciation in those two cases.
Amazing. Okay. Does this, and I'm going to butcher the acronym UFITGQRSTUV tax,
Correct.
is that applicable also inside of a Roth IRA, or is there no differential?
Such a good question. And this is what messed me up when I first heard about it. It's like, wait a minute, it's supposed to be tax-free and tax deferred. Even a Roth is tax-free. What are you talking about? But
Yeah.
it's income tax-free. This is UDFI tax. It's not income tax. So a Roth is still income tax-free, but it's not free of this tax. And by the way, if you want to read about it, if you want the chapter and verse here, what is it? Go to irs.gov and look up publication 598 and just read it, and it's in plain English, so it's not difficult to comprehend. So irs.gov publication 598 and go super deep on it. And a lot of times 990Ts aren't just filed by IRAs. For example, like I sit on the board of a charity and the charity has to file a 990T. So because charities are tax exempt, IRAs are tax exempt. You see where we're going here?
Yes.
So a lot of times tax people are very familiar with it if they've worked with 501c3s, for example.
Okay. Interesting. So, okay, we're going deep here. So we can take advantage of depreciation inside of our retirement accounts. Oftentimes we'll see, and you probably know this better than anyone, that when we use leverage, traditional mortgage, 80-20, 70-30, 60-40, what have you, the income is 100% sheltered by the depreciation, usually and then some, such to the point where we've got a paper loss. And we use that loss to then go offset oftentimes earned income from a job, depending on our income level, or if we earned capital gains from other locations. Does the paper loss carry forward from year to year?
Again,
in
tax
this 990T?
question.
Tax question? Okay.
Yeah.
Okay. And then so I'm thinking about doing a cost segregation study to then front loading a lot of that, a lot of the depreciation, especially now with the 100% the bonus depreciation coming back. That one I was aware of. Yeah. That's also going to be a tax professional question about whether or not to leverage that inside of a directed IRA.
I don't think you're going to get bonus depreciation in a self-directed IRA. I think you'll get it personally, but again, ask your competent tax professional.
Okay.
I'll tell you about self-directed IRAs though, all day.
Okay. Love it. This is so cool. Is there the type of leverage you're talking about through the self-directed, the non-recourse, the non-conforming, is it still 30-year fixed? I mean, can we go get these type of loans like just a regular mortgage?
You can, right. And so what you're going to do is talk to these lenders and talk to them about what their underwriting criteria are, because every underwriter is a little different. And I'm glad that I'm talking about this because when they're underwriting the loan, they're not just looking at your FICO score because they're not lending to you. They're lending to the IRA. So it's all about it. Your FICO score is irrelevant here. It's tell me about the property. I mean, its location and its condition matter, but really the cash flow is what matters. How is this property going to cash flow? And a lot of times, non-recourse lenders want you to already have a rental agreement in place before they'll close the deal. They want you to have a renter signed before they will go ahead and fund the loan. Is that crazy?
Yeah. Super. I mean, unless it's already an investment property, existing rental property.
Well, it needs to be, I see, an existing property. That's true. So what you want to do is interview some of these non-recourse lenders and say, this is my plan. How do we execute this?
Yeah. Okay, cool. I mean, it's very similar to a commercial mortgage where the lender is saying, hey, let's look at the debt service coverage ratio. How much income has a property produced? What are the expenses? What's the ratio? Yay or nay?
Yes, exactly right. It is a commercial loan. Yeah.
Okay, wonderful. And is there a loan limit? Like we have 10 loan limits for personal name. Do we have something similar in the IRA world?
Well, these are not portfolio loans. So normally it's sort of the the lender is going to make their own decisions based on the deal. But of course, with a non-recourse loan on an IRA, they want the IRA to have more skin in the game. So it's not going to be like you and I can buy a house with 5% down personally. But in a self-directed IRA, the lender's going to want maybe 60%, IRA, or 60%, from the IRA, and then 40% loan, something like that. So it's not going to be a 95% loan. It's going to, the ratios are going to change.
Okay. The LTV is going to be a lot less.
Right.
Okay. Wonderful. Kaaren, talk to us a little bit about backdoor conversions, if you could.
Right. Back to the Roth. Everybody loves the Roth,
Yeah.
and that's the game. So what you can do is obviously you can contribute to pre-tax accounts, like we're talking about your 401k, a traditional IRA, maybe even things like a defined benefit plan, if at your employer, something like this, and then move the money into, say, if you move it into a traditional IRA, and then you can convert it. Actually, with 401k, you can do an in-plan conversion. So whether it's in a 401k or in an IRA, you can do a conversion from pre-tax to Roth. All right. So when you do that, you fill out a conversion form. How many dollars do you want to convert? And that conversion happens. But understand that the amount you convert is going to be the same number on the 1099 that the custodian sends you, and that the custodian sends to the IRS. So the amount you convert is taxable to you, right? So that's going to go on your 1040 for that tax share.
Right. And so if we did this, just hypothetically speaking, inside of a single tax year, we contribute it to employee-sponsored 401k.
Right.
And so those are pre-tax dollars going in. And so we saw a tax benefit there. Then we converted it into Roth, again, in the same year. And so we're paying taxes. There's really no benefit to that in this side of calendar year, right? Because we're saving taxes on the front end, but then we're paying them on the back end. Okay. So I just wanted to illustrate that point for everybody. But where this is really powerful, because I actually did this several years ago, is I had a bunch of money from a 401k, and I then became a real estate professional. I left the job. I was doing real estate investing full time. Yeah. I did a cost segregation study. My taxable income was zero, and I had losses left over. I then converted money, this pre-tax money that I had, into a Roth 401k, and I didn't pay any tax on it except for the California state income tax, because they don't recognize real estate professional as a thing, which is a whole nother can of worms. But so I was like, I paid, I think 8%, 9%, something like that, on the dollars that I converted. And so
that's
I was like, oh my God.
Brass ring, man. That's like the best you can do.
It was amazing. So for everybody listening that maybe didn't follow that, it's okay. Definitely reach out to Kaaren and her team.
Yes.
Because this is something that is so powerful, and is just like pouring rocket fuel on your savings, on your retirement savings. So
by the way, we do offer a 20-minute free consultation. So if you want to go to our website, it's UDirectIRA.com. Just hit contact us, and you can schedule a consultation whenever you're available. And we'll chat with you. Like, what are your questions? What are your goals? What do you want to do? Because the other thing we want, when you call us, what we want to understand is, what deal are you looking at? And we want to listen to hear if you're about to commit what we call a prohibited transaction. Because if an IRA, if that happens, this little tax protected bubble of the IRA bursts. It's not tax protected anymore. Now there are maybe taxes in excess. So we don't want you to mess up. We want you to have a really awesome, smooth experience. So talk to us about this. Like, for example, maybe your IRA is about to buy a house, but the house is owned by your dad, and your dad is a disallowed person. So your IRA buying your dad's property is a prohibited transaction, but you don't maybe know that because you're new to this. So talk to us about your deal, so that you can hopefully steer clear of prohibited transactions.
Yes. No, it's such good advice. I think I know the answer to this question, but I'm going to ask it anyway. There's no use for 1031 exchange inside of the self-directed world, is there? Because capital gains really isn't a thing, or capital gains tax rather really isn't a thing.
Yeah, the 1031 exchange is with your personal dollars, because you're going to kick the tax dollar can down the road. With an IRA, you're already in a tax protected vehicle. So perfect. Yeah, so there's kind of oil and water there.
Okay, fantastic. Kaaren, you wrote a book, I believe. Can you talk to us a little bit about that and what readers could expect to find in it?
I might have it right here, accidentally.
Amazing.
Yeah, isn't that crazy? Yeah, no, it was super cool. I got to co-publish this with Bigger Pockets this year. So it's a Bigger Pockets guide to self-directed IRA investing. So it's a biggerpockets.com/SDIRA. and you can find it or find it on Amazon. But it's a guidebook, not really like a storybook, but it's a guidebook. So you can, reference, oh, well, how do I do this? And you can look it up.
Yeah. Amazing. Amazing. I think what I've realized through so much, having done this for a long time, and then also through our conversation, is there's so many permutations and there's so many variables. And yes, we all have access to the same tools, oftentimes, depending on whether or not we're employed, but how to use them to our best advantage in our personal situation is so unique to us. And so I think it's both fun, but also challenging when having these conversations to ask questions, because yeah, it's applicable to some people, but less so than others. But I think it only furthers your point, Kaaren, of needing to talk to a specialist and needing to talk to somebody that understands and will ask you questions. What's your situation? What are you doing? Because it is so unique to each and every person. Did I get that right?
You totally did. It reminds me of a story, if we have a second.
Yeah.
There was a couple and they were investing. And so husband and wife, they both had their own accounts. And each account, they had what we call a checkbook IRA or an IRA-owned LLC. So they each had an account. Each account had this special purpose LLC inside of it. And so they were and husbands and wives are disallowed. So this is the kind of a loophole here. This is kind of a fancy deal. So you can invest with a disallowed person if you close concurrently. So your names record on title at the same time. Yeah, no.
Say that again.
Okay. Disallowed people, husband and wife, parents and kids, can invest together, even though you're disallowed to each other, as long as you do so concurrently.
So what? Okay, keep going. I'm with you.
Yeah. So it just means as long as you didn't have a prior interest in the property, and neither one of you did, then if you close concurrently, it happened instantaneously. Your name's recorded at the same time, and it's sort of a loophole. So you can do that. Yeah.
Okay. So like my wife can invest 50% of her IRA money and I can invest 50% of my IRA money into a single deal, and
Correct.
That's okay. Okay.
Yes.
All right.
Well, here's this couple. So they're going to do this. They're about to do this. And so that's not even the issue. I mean, that was kind of fancy right there, but what they wanted to do is invest in this warehouse. And they were so excited about it. And so honestly, I talked to these people for an hour and we're talking about just talking this and that. And at the toward the end of the hour, they start to tell me about how this warehouse is right next door to the warehouse that they already own. Like, oh no. Okay, why is that a problem, right? Why would that be a problem? Because we know in real estate, if you own this property and somebody else buys this property, it's going to affect the value. Mm-hmm. So you're going to have, so basically it's going to impact it. There can be personal benefit. Like your IRA buying this property can raise the value of this property over here and give you personal benefit.
Did they own that first warehouse outside of their IRA?
Yes, they did personally.
Oh, okay. Yeah. Okay. Yeah. So if they had owned it inside their IRA, this wouldn't be a problem.
If they, in the same situation, correct. If they owned it concurrently. But also in their situation, there was also a driveway. And so there was an ingress and egress situation. And, it just got really complicated. But this is why you need to talk to us before you take down a deal in a self-directed IRA. Talk to us about and tell us who are the parties involved and what, do you own the house next door? It's relevant. Are you receiving personal benefit? There's actually some case law about this kind of a situation. So definitely talk to us before you pull the trigger.
Well, so what did the couple do? You can't leave us hanging. Did they buy the warehouse? Could they buy the warehouse?
They didn't. They didn't move forward. Yeah, they did it because they could see how this would be prohibited.
Great.
I think they bought it with their own personal cash, actually.
Okay.
Yeah.
Interesting. Okay. How much does all of this cost using a self-directed custodian? I mean, we're able to tap into these amazing resources, create incredible returns, all tax-free, tax-deferred. Like this has got to be expensive, right?
No, it isn't. It's not expensive, especially when you compare it to what you're paying somebody from, to have a Wall Street type account where they're actually taking a small portion of everything that you earn. We're not doing that. We have a $50 setup fee. It's a one-time fee up front, a $275 annual fee. It's a flat fee, regardless of the number of assets in the account and regardless of their value. And we ask you to leave a $500 pad for fees. It's not a fee, but it's just a pad in the account. So lots of self-directed IRA companies, everybody has a different fee schedule. Some charge like a sliding rate, like the more your account's worth, the more they charge you, like a percentage of assets. We don't do that. Flat fee. Some charge a flat fee, but then if you own real estate, it's like, an extra 100. dollars a year, or if you have a note, plus an extra 100 if it's a note, so it could be a flat fee plus, but we just have a flat fee, $275 a year. And we have, again, thousands of account holders, happy account holders.
Amazing. And then do you all charge a transaction fee? So I've got my money with you all now and I want to go buy this piece of real estate to help facilitate that transaction. Is there a fee for that?
The first 6 transactions for the lifetime of the account are free, not per year, but for over the lifetime. But after that, it's 35. Yeah, after that, it's $35 per transaction.
$35. So I go buy a house. I buy my 7th house inside my IRA, and you charge me $35.
Yes.
Where were you 5 years ago when I was doing that? This is incredible.
Right here. We didn't talk yet. Yeah.
Oh my gosh. Okay. So cool. So cool, man. We could go on for days. This is so much fun, Kaaren. My last question, getting back to the syndication for a minute, because I just invested in one outside of my IRA, but I've considered doing it inside my IRA. Mm-hmm. So you mentioned before that there could be this leverage tax associated with using leverage. And so it's important to ask the question. Mm-hmm. So what does knowing the answer to that question do? I guess it allows me to file that 990T or have my tax professional file the 990T. But what do I do with that information? Is there something, should I then reconsider investing in that syndication? Or is there something I need to do differently from a tax consequence perspective in order to not get hit with this tax? Can you talk to us a little bit about that?
Yeah, that's such a good question. If there's leverage, there's going to be this tax. If your IRA earns profit due to leverage, there's the tax is going to exist. So, and it exists for a year and a day after the deal, like after the deal closes, for any proceeds that you receive from that. So just know that it's not just that's when it ends. So understand the tax, talk to a tax professional, and like any deal, put it on a spreadsheet and factor it out, because what you want to really understand is what is your profit really going to be, assuming this is the rent that you're going to receive and these are your like projected rent increases, mm-hmm. and you're looking at this and how much you're going to be able to reduce the tax because of maybe a cost seg or some other kind of, write-offs that you might have, and partner with your tax professional, create a spreadsheet. It may sound complicated, but it really isn't. It's just putting numbers on paper and look at those numbers, and that's going to give you some answers and give you, your plan will be evident then.
Yeah, this is so good to know, because I'm sure, like so many of our listeners, as they're evaluating syndication opportunities, so many of these sponsors are doing value add to a cash out refi play. Mm-hmm. And so that cash out refi is going to have a much bigger impact on a tax perspective than mm-hmm. day one going into this. So I think, to your point, modeling this out, not only in today's model, but also mm-hmm. based on their projected cash out refi, what does that look like from a tax consequence perspective is super critical.
I don't want to scare people away from self-directing. You open an account, you fund it, you invest. But I think it's important that we're digging in deep here, because you don't want to go in and not fully understand your responsibilities either.
Yes.
It's not just like buying a pack of gum at the store, there are things to think about. And as an investor, we already know that. We already know that we have to look at the numbers. So if you're already an investor, you already know how to analyze a deal. So these are skills you already have. You just have to put them to use, I would say.
This is great. If somebody invests with their self-directed through you all or another facilitator, and then decide, actually, it's not for me, it's not as good of a return, can they then go back to a Fidelity, or can they invest in like the market that they had access to with a Fidelity like through a self-directed as well?
Right. So we don't sell any assets. So we're not broker dealers. So they can absolutely move their money back to the market. Absolutely. So if they say, hey, this deal isn't working out, they can, like, it's a house, they could sell the house. All that cash goes back in their IRA. Then they can transfer that cash, say, to Fidelity or something like that. Absolutely.
Okay. Man, I feel like the opportunities are just like endless. We were saying before, the variables and the permutations are so endless. Yeah. This was only scratching the surface. Kaaren, mm-hmm. This was so much fun. I really, really appreciate you taking the time. If people want to reach out, rather, I should say, when people want to reach out, because if they've listened to this, they absolutely will.
Yeah.
What's the best place for them to do so?
We're all over social media, like Instagram and, LinkedIn, Facebook, all that. But really our website, we have a very robust blog. So if you have any questions, probably answered in our blog. So it's the letter U, UDirect IRA.com.
Wonderful.
Yeah.
Wonderful, wonderful. We'll definitely post that in the show notes. Kaaren, thank you again. Really appreciate the time. We will be in touch soon.
Thanks, Michael.
You got it. Take care. All right, everyone, that was our show. A big thank you to Kaaren for coming on. Super, super interesting stuff. And again, there are just so many permutations and options and functionality built into these self-directed programs. So definitely reach out to Kaaren and her team or one of the other self-directed facilitators or custodians that you are working with. As always, we'd love to hear from you. Ratings and reviews are really helpful. What do you want to hear more of? What do you want to hear less of? Drop us a comment, and we look forward to seeing you on the next one. Happy investing.